Welcome, everyone. We are here today to talk to you about an exciting new strategy that we've launched at Fusion. We've launched this with our partnership with the Burney Company. And so, what we want to talk to you today about is a 130-30 strategy. And so, this is really taken off in the industry. We're seeing lots of interest in it, but not alone just with us. I think interest generally in the space. And so, if you've not heard about a 130-30 strategy, you're missing a boat here and you need to pay attention because it is a very unique opportunity. In the last year, for example, in the start of 2025, there was about 20 billion in the strategy collectively across the market. It ended the year at almost 100 billion and has already jumped up to 120 billion in assets across the market. So that is more that's in the entire buffered ETF space. And it is still a very hot strategy. My contacts at Schwab and other custodians are saying that there are money managers and RIAs lined up to try to get this strategy on their platform. We started working on this almost a year ago, and so it has taken us a while to get it up and running, to get it approved, but we do have this strategy up and running, and it is available today, and there are some very unique opportunities by using this strategy, and we're going to take you through those today. And so I'm going to introduce you to Andy Pratt, who works with the Burney Company, and talk a little bit about the specific strategy in the space as well. Andy?
Yeah, when I think about why this space is experiencing that kind of explosive growth, I think there's really like four key trends that are driving it. One, clients and advisors already have long biased exposure. You're already believers in the compounding impact of the market, and that long equity in client portfolios that already exist just fits naturally with a 130/30 extension without really having to change much in the core positioning. I think the second reason why we're seeing the trend is tax alpha is more reliable than performance alpha. So if we look last year, only 28% of active managers beat their chosen index, but that tax alpha can be a lot more predictable regardless of the market direction. And I think another big trend that we've seen after 10 plus years of bull markets is you just have ossified portfolios these days. Many clients are stuck in concentrated positions or low basis mutual funds that they can't easily exit. So this 130/30 creates a path to diversify and help manage some of those embedded gains that are in legacy positions. And then finally, to your point about custodian support, Bryce, Schwab, Pershing, Goldman Sachs, and others have all stepped up with promotional margin rates and operational support that just make it a lot more accessible than ever to run a long short strategy.
I think that's very key, and we do have that approved and up and running on our platform today with Schwab. I think one of the examples that I hear across the space all the time from existing advisors is they run into clients that are either already an existing client or it's a prospect that they run into that has these positions that have large capital gains that makes it hard for them to manage those assets. So the advisor wants to manage the assets, wants to help diversify the client, but the client doesn't want to sell these positions because they have such a gain. That could be through what's happened in the last 3 or 4 years with Nvidia, Broadcom individual securities that they have low basis on, or even we've run into several examples where somebody has mutual funds they've held for 20 plus years and they want to try and get out of those mutual funds into more effective strategies that have lower expenses, but they just don't want to pay the capital gains. And so that's why this strategy is so unique and it allows you the opportunity to do that. And so we're going to go through some of the specifics of that strategy with you now.
Right. The key benefits are performance alpha and tax alpha. So I'll talk through some of the mechanics, some of the logistics for how this 130/30 structure can achieve both those things. And then we'll talk a little bit about our, specific implementation as well. But just generally, what is a 130/30 strategy? So you're going to take an existing portfolio, let's say it's $1 million portfolio, and you're going to add 30% or $300,000 in my example on the long side. So you're using margin and you're going even more into your highest conviction positions. But at the same time, you're going to be shorting $300,000 of stocks that you have a bearish view on, your lower conviction positions or overvalued stocks. So it's key to understand that your net market exposure remains 100%, the 30% and the 30% cancel each other out, so you're still left with your net 100% portfolio. This is not a hedge fund. We're not taking risk off the table. You still have that market beta, but it's also not speculative. We're not adding leverage and increasing the risk level of the portfolio. It's still that net 100% exposure. And the key thing here is that short side. This is the way I think it's easiest to think about it. That short side generates proceeds that fund the additional long exposure. So this can amplify both our bullish and bearish views on a stock. And the way that the unique tax advantages come in is unlike a traditional tax loss harvesting strategy that will struggle to find losses in strong up markets. This strategy can harvest losses even when the markets are rising.
I think that's really the key unique positioning of how this portfolio works. I mean, all the advisors have heard of tax loss harvesting, right? You buy a portfolio, and then over a couple of years, you're selling the losers to generate tax losses. But when you run into a situation of what we've seen in the last, 3 or 4 years with such a strong bull market, there's no opportunities to sell losers because most of the market has gone up. This is such a unique strategy because the way it works is it generates the losses as the market goes up. So the years when it's generating losses on your short side is because you actually have up markets. And so with the market generally, over the long period going up and to the right, this is a strategy that actually generates those losses while the market goes up, which is unique to the way that most tax loss harvesting strategies have worked in the past. And so just so you know, this is a live strategy we have today. It is up and running on the platform. If you are a retail client, for example, and trying to put this strategy in place, you'd probably pay 6 or 7% on the long side for the margin rate for the part that's 30% borrowed, and then you'd get no credit for the short side. Our net negotiated rate that we have today to have this strategy running is only a net carry rate of 95 basis points. So less than 1% to be able to run this strategy today on the platform. It works as a standalone strategy or as part of your portfolio. It doesn't have to be, an all or nothing, but it does allow you as the advisor to be able to bring in these assets you normally couldn't manage, unwind those by generating losses to continue to sell and unwind the basis issue on the strategy, and then be able to put those assets to work in the strategy that you would like. You can run it two different ways, as a standalone strategy, or if you have these big long positions that have been held for a long period of time, we can run it as an overlay to that strategy on $1 million portfolio as well. And so not only is the strategy effective, and we're a big believer in this, and we're seeing advisors that really kind of grasped onto the strategy grow very quickly. It's also important to make sure you're partnering with the right firm. And I can't say enough good things about being able to work with Bernie here on this strategy, because using an ETF on the long side that is a 5-star rated fund makes a difference. You're generating alpha because of having a great manager running the long side of your portfolio. They also then run the short side in the SMA for us, for you as your clients. But we've had such good success with them on their portfolios in the past. And I think that really does make a difference in the strategy and its effectiveness.
You make a great point about performance alpha being key here. A lot of times when we talk about long short strategies like this, people lead with the taxes. We led with the taxes as well. But that 95 basis point negotiated margin rate that you talked about, I consider that the hurdle rate that needs to be overcome for this to really make sense. And so we have been running our long short strategy since 2017. That's nearly 10 years of experience shorting stocks, which many of the newer entrants in this space simply don't have. A lot of direct indexers are trying to enter the 130/30 long space because they're dealing with that same ossified portfolio problem that we talked about earlier. But historically, they've been long only managers with no shorting history. So our track record, as you pointed out, is validated by the fact that we've got our SMA strategy going back decades. We have our ETF that we run on the long side of this that can defer capital gains on the long side and has been rated 5 stars by Morningstar. And that performance alpha piece, I think, is crucial. One of the behemoths in this space is AQR, and they always do a great job of sharing research. And what they shared recently is that without genuine alpha, the fees and margin drag of a long short 130/30 strategy can offset the tax benefits. And that makes manager selection critical. So, one question I have for you here, Bryce, is how does this long short strategy fit into the Fusion platform?
The model is already up and running. When you come in, you open the account, it is in a separate SMA account where it's set up to be able to run the long side. And then the short side is an SMA of individual positions that are managed and on your behalf. So once you have the client set up and running, there's little else you need to do. We'll be running that strategy with Burney for you. So it's as simple as setting up the separate account and you can be off and running. I think this is something that we've been trying to do, whether you're with Fusion today as an existing advisor or you're an advisor that is considering us as an alternative. It's just the kind of sophistication that we're bringing you that you traditionally don't get. Normally, to get these kinds of strategies, you've got to be a very big advisor. And so we're trying to bring the types of things that allow you to advance your clients with different sophisticated strategies like this that can be very successful in the market and help you actually bring in clients that you may not have been able to bring on before because of those strategies elsewhere. So it allows you to go up market to larger accounts and then be more successful with those clients as you can offer different types of strategies.
So, how can advisors seeing this video access this long short strategy through Fusion's operational platform?
So it's as easy today as if you're an existing advisor, like I said, we can be up and running and set that account up with you in a matter of minutes. If you're not an advisor with us today, feel free to reach out to us. You can connect with me on LinkedIn if you'd like to talk about it, as well as you can go to www.fusioncm.com. You can schedule a demo with our sales advisor, Stephen Watkins, there, and we can get you up and running as well. So, like I said, the platform is already operating. The 130/30 strategy is being used by advisors and clients currently today. So it's approved and running and ready for your use.